The Bank of Canada, it has made an unusual move to fight the painful price of inflation being felt across this country. It pushed up its benchmark interest rates by half a percentage point. The last time it was this aggressive was back in the year 2000. CBC business reporter Jeannie Lee is on the story. So where does this leave the bank's rate? And of course, what people are thinking as they watch this at home, where does it leave the consumers and the rates they pay?
Well, exactly. Those are the big questions of the day, Suhana. And we'll start with the bank's key policy rate. It rises to 1% even. And to keep things in perspective, 1% is still very low. It's just not as low as Canadians had become used to during the pandemic, when it was at rock bottom, a quarter of a percentage point. So I don't know if we have a graph. I did ask for one to be prepared, but it would show you, if we did have it, it would show you how rates were pretty much on the rise throughout 2019. And then the pandemic hit in March of 2020. Rates were slashed down to practically zero, and they've stayed there since. But with rising inflation, and certainly we saw a rate hike about 6 weeks ago, and again today. Today's was 50 basis points, which has not happened since the year 2000. And back then it was because, again, of inflation. Inflation had tripled in the previous 2 years before 2000, and so there was this outsized rate hike. Today, we are looking at inflation that has tripled within just 1 year to 5.7%. That is why the bank has to move. And I don't know if we have a remark from the bank governor, Tiff Macklem. If we don't, I will paraphrase him. He basically explained that, you know, this rate hike is necessary, this outsized rate hike is necessary because of all of the issues that have driven up inflation. We know what it was, the various supply chain issues and shortages, rising prices of commodities, all exacerbated by the most recent big event in the world, and that would be the war in Ukraine. So the fact is, what that's done is it's fueled inflation in just about everything that consumers pay. There is no place to hide. Have a listen.
We're also concerned about the broadening of price pressures in Canada. With about 2/3 of CPI components growing above 3%, Canadians are feeling inflation across their household budgets, from gas to groceries to rent.
And so with the current inflation rate, the latest inflation rate at 5.7%, the highest in 31 years, you can expect, and the bank has confirmed, that these increases will continue, these rate increases, for a while as the economy grows after the pandemic, but also inflation has remained so stubborn.
And how much more will rates rise? Was there a number put on that, Jeannie?
There wasn't, but there was a word, and the word was neutral. So, you know, what is a neutral rate of interest? The neutral rate of interest is what the bank was talking about. And what does that mean? The bank governor would not quantify that, but he said that in the past, the neutral meaning between 2 to 3%. So I don't know if we have the points that I prepared earlier. If we don't, I'll just talk about them. So Tiff Macklem said we do need this so-called neutral rate, which is neither stimulating borrowing and spending and prices, but also not dampening them either. So, you know, sort of like that bowl of porridge that's just right. Neutral is hard to predict, but again, he said 2 to 3% in the past has been a reasonable neutral rate. So notice 2 to 3%, that's double or triple where rates, the official rate is today. Now, every 50 basis point jump in rates, we should say, this is how it's going to affect people with a mortgage. If you have a mortgage that is the average $355,000, that's across Canada, that'll add about $82 per month, and you can double or triple that depending on where you live. Now, higher rates also make business investment more costly, so that's something that the bank doesn't want to discourage. So, you know, it's a fine balancing act here, but I guess the word of the day today, Suhana, is neutral.
So while higher inflation is costing everyone more, Some people obviously worried about the rise in interest rates and what it will do to their mortgage rates. Will it make them unaffordable? The Prime Minister was asked about the risk of that today during an event in Quebec.
We put forward a budget that puts strong and concrete measures to Canadian families to be able to help them with housing. We know that there is no one thing that any government can do to solve the housing challenges. Every family is in different situations, and the approach that we have to take must be multifaceted. That's why we're helping people save money with a tax-free savings account, tax-free on the way in, tax-free on the way out, up to $40,000 towards the down payment for a new home. We're also moving forward with creating more greater supply of homes, and we're cracking down on speculation. We know that the cost of living is going up. There are challenges with interest rates, there are challenges with the price of gas, there are challenges with the price of groceries. And what we demonstrated with this budget was a way of being there to support families without making it worse by remaining fiscally responsible.